Hi, how are you? How's everything? Okay, today's discussion will be on this consolidation. Today we will discuss uh, about consolidation. We will study consolidation. The basic idea is the basic the very basic idea is when parent company acquires company B or like subsidiary company. So this is the basic like uh, basic idea behind this. Suppose when one company acquire or purchase share in company B. When one company acquires shares or purchase company B shares, when they acquire, so they are purchasing their shares, they are purchasing their equity, they are purchasing their liabilities, they are purchasing their assets. So you can say they are purchasing the net asset of company B. So in this we will study two different aspects. One is if they are selling more than if they are purchasing more than 50% or less than 50%. If company A suppose company A purchases company B, if company A purchasing more than 50% of shares of company B, so that the company acquiring company will become the parent and the other company will become the subsidiary, and you will have the control. If more than 50%, it is more than means parent company will have control. And if they are having a less than 50, company A acquires company B but less than 50% of their shares, then this subsidiary company, the other company, they will become associate, and they will not have the control, no control, but they will have significant influence. They will have the significant influence in company, subsidiary company. So we can say if they are purchasing more than 50% of the company, subsidiary company, it means it will become the relationship will become the parent company which acquires and the subsidiary company who is selling their shares. So they will become the parent and subsidiary. And if they are having more than 50%, it means the parent will have the control over the subsidiary. And acquiring means they are purchasing their shares, they are purchasing their liabilities, they are purchasing their assets, and because they are buying a running business, so they must pay goodwill as well. It means they must have paid goodwill for the goodwill. So it means they must have paid, suppose 20% of the, if suppose company B subsidiary company has total net asset 20,000 suppose, and cash consideration paid, if the cash consideration paid 50,000, suppose 30,000, they paid 30,000 and they are buying 20,000 shares, it means extra 10,000 they gave it for goodwill, because they are purchasing the running business. So I'll show you company A. 80, suppose if they are buying 80% of the company B, it means this will become parent company and this will become subsidiary. So as individual company, they are two separate identity or two separate entities. Individually they are two, but as a group they are one. So as a group they are one. So in consolidation we will consider as a group, as group point of view they are one. We will consider them one. So I'll let you know about I will teach you from the very beginning, from the very basics. So suppose I will show you an example. So this is a parent SOFP and this is subsidiary SOFP. So parent has, suppose net as first statement of financial position, first start from NCA, non-current asset. Suppose they have a non-current asset of 10,000. Now investment in company S. So in company subsidiary, suppose 5,000 shares. Share capital always be on par value. So it means they have acquired, a parent company acquire 100% of subsidiary, 100% acquisition. It means subsidiary company issued 5,000 shares and all 5,000 was acquired by parent company. So investment in share subsidiary company is 5,000. So this is the investment. Current asset, how much the current asset? The current asset is 5,000. So how much in total? 20,000. And equity section, let's make an equity and liability. So ordinary share capital of parent is 10,000, suppose, and liability of the parent is 10,000. Okay, this is SOFP of parent. Let's talk about the statement of financial position of subsidiary, S company, subsidiary, and P company. You consider it as this. So asset side, first asset NCA. Suppose this they have a NCA of 10,000. Current asset, they have a current asset of 5,000. And equity liability, I told you already, ordinary share capital, they have issued 5,000 only, which we have already acquired. And liabilities, so it's 15,000. So these are two separate entities, statement of financial position. So these are two different entities, but individually, but as a group they are one. So we need to add everything together. Just make sure this and this, you need to ignore this with this. So because if you take 5,000 here and 5,000 here in the statement of a financial position, it means you are making it double, so it will make your answer wrong. So when it comes to statement of statement in investment in the company S, you should ignore with the ordinary share capital of this S company. So if you leave these two, the rest you just add together. So let's add it. So non-current asset with this non-current asset add together. So non-current asset, now we will make consolidated statement of financial position. First is asset, add this asset plus asset, non-current asset. Parent company has 10,000, subsidiary has 10,000. So it means as a group they have 20,000 asset, current asset. Now let's talk about the current asset. Current asset this and current asset this and this, add them. Current asset as a group, parent has 5,000 and subsidiary has 5,000. So it means they have 10,000 in together. So liabilities, add these two. Liabilities, parent has 10,000 or subsidiary has 10,000. So asset, this is asset side, asset is 30,000. And liability is done. And share capital, just take this one only, just ignore this, ignore subsidiaries share capital, just take ordinary share capital of parent only. Ordinary share capital of parent is 10,000. If you add these two, it is 30,000. Okay, so the thing is, this will be adjusted when you calculate the net asset, because this is part of the net asset. So there are two methods of doing it, but we will gonna do the consolidation. Almost all the companies are doing consolidation with the net asset method. Let's do one more example. So I told you already, we are, when a parent company acquires subsidiary, so they are acquiring their assets, they are acquiring their liabilities, they are acquiring their equities. So when because they are buying a running business, so the running business must be having any goodwill. So we need to pay for the goodwill as well. We need to calculate the goodwill. So there are two methods of calculating goodwill. So the first method is proportionate method. Let me draw a timeline to make you understand. 1st Jan x6 and 31st December x6. On this date, 1st January, parent company acquires company B. Parent company P company acquires, suppose we say 80% of, parent company acquires 80% of company S shares. It means they acquire 80% of share S. That date, this date will be the acquisition date. And I told you already, let me tell you this, who will prepare the consolidated balance sheet, the parent or subsidiary? It is the part of the duty of the parent company to issue a consolidated SOFP. So it means parent company will prepare consolidated balance sheet, consolidated statement of profit and loss, and consolidated SOFP, not the subsidiary. So this is your acquisition date, and this is the date when you need to report. Reporting date, it means this is the date when the parent company has to prepare and report SOFP. So let's see, if we add this date, net asset acquisition date, net asset of S company at acquisition date are ordinary share capital. If they has, so suppose they has suppose ordinary share capital they has 10,000. Ordinary share capital, the S company ordinary share capital is 10,000, and in part of F7 ACCA financial reporting paper, it is one of the scope of the ACCA F7 paper that once the share are once the company parent company acquires subsidiary, then the subsidiary company will not issue the new shares. It means in F7 this value remains the same. It means after acquisition, subsidiary will not issue any more shares. Premiums per share premium is 5,000, and retained earning. What is the retained earning? 10,000. So total package is 25,000. It means the total value of these assets is 25,000. At reporting date, what is the reporting date? Ordinary share capital, which I told you already, it will be the same in F7. Share premium is 5,000 again, and retained earnings. Suppose after acquisition they made a profit, and they made 30,000 total. So after acquisition is posted, after at the reporting date they have 45,000, and at acquisition the net asset value was 25,000. If you take a difference of these two, it means 20,000 post acquisition. So after the acquisition, post acquisition retained earning, so you can see the retained earning, this one is 0 already, because if you take a difference of this and this, if you take a difference of these two, if you take a difference of these two, it's just 0, and if you take a difference of these two, is also 0. Only this is value is changing, retained earning is changing. So it was 10,000 before and 30,000 after. So it means if you minus 30 minus 10, it means 20,000 is a post acquisition retained earning. So how we will calculate goodwill? How we will calculate goodwill in proportionate method? So first we take cost of investment, how much we gave in as a investment, how much we gave to subsidiary, how much we gave it to subsidiary. So cost of investment, suppose is 40,000, and I told you already we have purchased 80%, so we pay to S subsidiary company about 80%, we acquire 80%, so this is 80%, so it means we have 40,000 is for the 80% of a subsidiary shares. So this is the consideration we paid. So how much how much net asset we got in return? So this is the amount we pay, this is the amount the parent company pay to acquire it. So the less, so we minus less net asset net asset of S company. So do we need to take this value at the date of acquisition, or this value which is post acquisition? So please do keep in mind, we need to take at date of acquisition, net asset of S company at acquisition date, because we are acquiring it, so we need to calculate the goodwill on that date. When we are buying a new company, when we are investing in a new company, we calculate the goodwill on that date. So net asset of S company at acquisition date, which is this. So how much we it was 25,000, but how much we pay, how much we take, how much we acquired? 80%. We acquired 80%. See here. So we acquired 80%. We need to take 80% of 25,000, which is 20,000. It means we paid 40,000 and we get benefit of 20,000, or you can say we are paying 40,000 but we are getting assets valuing 20,000 value. So the difference, which is 20,000, it means you are paying extra 20,000 extra. You have paid 20,000 extra, which is of the goodwill. This is a goodwill of the new company. So we are taking 80% and 80%. So we are paying 80% for it. Then we have to take 80% of the net asset. After this, we calculate this, because out of this, if company was having 100%, out of this we are getting 80%. We are buying 80% and 20% belongs to someone else. Parent has a control, and this have no control. So we can say no control interest, or we can say NCI, non-controlling interest. So after this we have to calculate non-controlling interest, NCI. So 80% belongs to the parent and 20% belongs to someone else, which we do not have any right. How we will calculate this? We have taken 80% of this. Now we will take 20, because net asset out of this is 100% of the acquisition date, 100% net asset of the subsidiary. Out of this 80%, this is the net asset. Out of this 80% belongs to us, and 20% belongs to NCI. So this NCI is here. So we will calculate. How we will calculate? Because S company net asset at acquisition date, it was 25,000. So because 80% belongs to us, and 20% belongs to someone, so take 20% of this, which is I guess 4,000 or 5,000. And after during the year the company must have produced some profit. So it means this, the post acquisition profit or post acquisition retained earning. So we need to take post acquisition, add post acquisition retained earning. Company made, after acquisition company made 20,000. So 20,000, and we have 20% NCI, because 80% belongs to us and 20% belongs to someone. So this 20% belongs to someone. If you take this, it means 4,000. So if you add these two, NCI is 9,000. This is your NCI. This is your NCI. We have calculated NCI. Now after this we need to calculate consolidated retained earning. So we need to calculate consolidated retained earning. As a group we need to take. So in this, take 100% of retained earning of parent company. Take 100% of parent company year end retained earnings. Suppose we don't have in this question anywhere, so add. So we have taken 20% here, so after post acquisition, so 80% belongs to us and 20% belongs to NCI. This is parents, so NCI is here, and this 20,000, 80% will be here, 80% here. So after acquisition they made 20,000 more difference. So after post acquisition retained earning of parent company, so they made 20,000, but we have 80%, right? So 20% we have taken here and 80% we are taking here. It means 100% complete. So it means if you take 80% of 20,000 will be 16,000. So this will be your consolidated reserve. So this is the way we calculate the goodwill, NCI and consolidated reserve. So this is one method. I'll show you the next method of calculating the goodwill. The second method is, we are taking 80% of the net asset here. We are taking only 80%. So one of the guy in the board says, if we are taking 80% of because we purchase 80% of subsidiary, it means we are taking 100% of net asset. We are getting total asset of S company. So why not goodwill? So why not we calculate goodwill? So board introduced a new law. The board introduced the new standard. Board introduced the new method of calculating goodwill. So in this goodwill method we will add 100% of the goodwill. So I'll show you the 100% how we will calculate in this. So full goodwill method. So same thing. 1st Jan x6, 31st December x6, reporting date, and this is acquisition date. And suppose we have taken same 80%, company acquires 80% of the company S. P to S is 80% acquires. So they acquire S companies 80% of the shares. So L will prepare the net asset package now. Net asset of S company at acquisition date. The package is ordinary share capital. Suppose in this we have same 10,000 and retained earning is 10,000. So it means they have 20,000 here. So I told you already in F7, once parent company acquires subsidiary company, then the subsidiary company will not issue more shares. So ordinary share capital will be the same, 10,000, and suppose retained earning after 1 year, retained earning goes to 30,000, so it becomes 40,000. So it means if you take a difference of these two, it means post acquisition is, I write it here, post acquisition is, if you take a difference of these two, it means 20,000 is a post acquisition. This after this post acquisition has 80% of parent and 20% of NCI, because 80% belongs to us. This 20,000, out of this 20,000 profit, we 80% belongs to us and 20% belongs to someone else. So how we will calculate goodwill? First thing, cost of investment. Suppose we are paying 80% because we are acquiring 80%, so cost of investment is 80%, because we must have paid 80%. We must have paid 40,000. Suppose 40,000, this 40,000 is equivalent to 80% of subsidiary company. And we need to take 100% of the net asset. Suppose the net asset is less net asset of S company at acquisition date. Please do not take post dated, always take date of acquisition. So acquisition net asset is 20,000. We need to take first, in the previous question we need to take 80% of acquisition, then we take 80% of the net asset. Okay, so net asset of S company at acquisition date is 20,000. In previous question we take 80% acquisition, so we take 80% of the net asset, but in this we need to take 100% of the shares, so 20,000. So this belongs, this shows 100% of the subsidiary asset, it means 100%. So we are getting 80% and 100% is the net asset, so it is not a like with like comparison. So to make it like with like comparison, we need to add one thing in it, which is fair value of NCI at acquisition. So don't worry, this will be given in the exam. This will be given in the exam. So suppose if we have 10,000, so 50,000 here, so less this, it means 30,000 is your goodwill. So cost, if you see, this is 20%, this bill shows 80%, this shows 20%, total is 100%. So 100% here and 100% here. So now it shows like with like comparison. So this amount will be given in the exam. So after this we have to calculate NCI. How we used to calculate NCI? We calculate NCI with the fair value of NCI, which I told you this, it is given in the exam. Fair value of NCI at acquisition date, which is 10,000. We need to add post acquisition. So this is your post acquisition, this is your post acquisition. So post acquisition because after 1 year company must have made some profit. So company must have made some profit. So post acquisition we need to take NCI, sorry, we need to take 20% because 20% belongs to someone. So take post acquisition retained earning. How much retained earning was? The post acquisition is 20,000, so 20,000 retained earning, but we need to take 20% of this, so which is 4,000. It means 14,000 is your NCI. After this we used to calculate consolidated retained earning. So how we will calculate consolidated retained earning? It's very simple. Consolidated retained earning is 100% of retained earning parent retained earning, parent company retained earning, tot 100%. Suppose we have, it's not given in the exam, so parent company retained earning plus post acquisition retained earning of S company. Subsidiary, post acquisition subsidiary made 20,000, so 20,000 into 20%. Suppose we have 4,000 here. Oh sorry, it's 80%. We need to take 80% because we have taken NCA for 20%, so we need to take 80% of in consolidated, because 80% in consolidation is 16,000. So this will be your consolidated reserve. So you can see here we have taken 20% and 80% we need to take here, because this is consolidated reserve. Consolidated reserve will, this is 100% of, this is 100% of parent company. So we need to take parent company retained earning, and then because after acquisition subsidiary company made 20,000 profit. In this 20,000, 80% belongs to parent and 20% belongs to NCI. So 20% we have taken here and 80% we need to take here as in consolidated reserve. These are the basic point, because we this is the most common method, full goodwill method, because we have taken 100% of the net asset, and then because we are paying 80%, we are acquiring 80%, we take 80% effect, and this value will be given in the exam. So we need to add fair value of NCI at acquisition. So if you add these two, it will become 100%. So 100 plus 100 means these two are like with like comparison. So this is a basic idea about the consolidation. After this we will practice a few more questions, and after this I will show you the next part with this is SOFP, but tomorrow I will record, maybe not tomorrow, maybe in the next few days I will record consolidated profit and loss statement. Please do tell your friends to subscribe my channel. Alright, see you in the next session. See ya, bye.